Okay, good morning, everyone. Welcome to Phillip Securities Research Morning Call for the 10th of January, 2022. So for today, we'll have quite a number of macro sector outlooks. We'll begin with the FAANGM Monthly for the month of December, followed by some technicals on Nasdaq 100 and the FAANGs. And then we'll continue with the Singapore Banking Monthly and a small and short case study on buybacks, and we'll end off with the standard Singapore Weekly. So without further ado, I'll pass my time now to Timothy to get it started. Timothy?
Yep, thanks, Jonathan. So we just get started with the FAANGM Monthly. So FAANGM stands for Facebook, Apple, Amazon, Netflix, Google, and Microsoft. So we're just looking at the biggest tech companies in the US for the month of December 2021. So the title is Apple and Meta. Meta, which is Facebook, they changed the name to Meta. They shine during the month. Okay, next slide, please. Okay, so just an overview of the big tech. So the FAANGM lagged the S&P 500 in December. So the FAANGs only returned about 3.1% versus the S&P's 5.6%. Okay, pardon the phone call. So the laggards, the outperformers were Meta and Apple. So Meta returned 8.3% and Apple returned 7.8%. But the laggards were Amazon and Netflix. So they declined 3.2 and 2.5% respectively. So we'll just go into what caused these the movements for these stocks later with the news that happened. Okay, so for Apple, the reason why they performed so well in December was because of two big positive news. So the positive news for them was that they won an appeal to delay the rolling out of changes to the App Store. So the App Store is the App Store on Apple's platform. So just to give you a rough idea, it's estimated to contribute about 10% to Apple's gross profits. And so there's just some background to the ruling. So there was a Epic Games lawsuit on Apple, of which Apple won 9 out of 10 of it, but they lost one. So the one that they lost was a ruling that wanted to allow users on the Apple platform to allow payments outside of the App Store. So this will affect whatever Apple earns from the App Store, because they take 30% cut of whatever spending that happens in the App Store. So if Apple allows users to pay outside the App Store, then that may affect the App Store earnings. So what happened in December was that Apple successfully appealed to delay this ruling, so they don't have to make these changes to the App Store payment system. Likely it could delay it for years. So that's quite a big positive for Apple. The second positive for Apple was that there were some rumors on the new AR/VR headset. So AR/VR is augmented reality or virtual reality. So they may launch a new headset this year, in the second half of this year, probably in June 2022 in their Worldwide Developers Conference. So this is big. This was a very big positive also for them, because it's a headway for them into the metaverse. So this will help them is focused on reaching the communication, media consumption, and gaming sectors also with regards to the metaverse. So this launch is expected to have quite a meaningful impact on Apple. With regards to the headset itself, it's rumored to have very powerful computing power. So within this headset comes the equal computing power as a Mac or an iPhone. And this headset can work on its own without connecting to a Mac or an iPhone. So it's just a new independent device on itself. So just some color on the second positive news for Apple. Okay, for Amazon was the laggard, so they declined 3.2% for the month. This is because of ongoing share price pressure from higher labor costs and freight costs from the supply chain issue in the US, and also some regulatory headwinds. So in the news, there was ongoing investigations by the Federal Trade Commission on its cloud business, and also there was new complaints about the ads on Amazon's e-commerce platform. whereby they don't distinguish between the paid search ads results and the organic results. So users can, so basically the complaint is saying that users cannot differentiate the ads from normal search organic results. So users may not know that what they're seeing is actually an ad rather than what is truly organic or a popular product. So that's another complaint, another headwind for Amazon in the month. That's why their share price was a bit pressured. But despite this, we are still positive on Amazon as these supply chain issues and pressures eases as we move into 2022, and also because the performance this year can perform better than last year, relatively easier because of the easier comparables to last year. Okay, lastly for Microsoft, not much news from Microsoft except their acquisition of Nuance Communication is making headroom. So it was approved by the European Commission. It was granted approval, and this is Microsoft's second biggest acquisition ever. So the biggest one was LinkedIn. So, but this one is an acquisition of a speech recognition and artificial intelligence software company, which is focused on the healthcare sector. So this will help Microsoft breach into the cloud computing as industry-specific solutions for the healthcare sector itself. And the last news for Microsoft is that they confirm some price increases for their Office product. So there is for monthly subscriptions for the retail customers, there will be increasing prices by up to 20%. This may push people over to the annual subscription plans and help Microsoft to get more income visibility with regards to the retail Office products. But we don't think this will impact Microsoft much, simply because the retail segment of the Office products doesn't generate as much revenue for them compared to the commercial side of things. Okay, to Jonathan, pass over my time to Jonathan.
All right, thanks, Tim. So we'll move over to Meta platforms. So one of their positives for December is that Instagram actually surpassed 2 billion monthly active users. So it actually crossed the 1 billion monthly active user number in 2018. So it only took them another 3 years from then to hit 2 billion. It really shows that continued strength in user growth for Instagram. And this actually represents a 26% compound annual growth rate over the last 3 years. So just to put into perspective, Facebook's monthly active user was only growing at an 8% CAGR over the last 3 years. And so this places Instagram's growth rate at more than 3 times that of Facebook. So proving it again that it is actually an additional growth driver for the company as a whole. Second positive is that WhatsApp actually started to introduce crypto payments feature on its platform. So this pilot scheme actually allows like a select group of users to conduct cryptocurrency transactions seamlessly on WhatsApp. So these transactions are actually conducted using USDP, which is US PEX dollar, this one USDP is actually pegged to $1. So we believe that there's huge runway for revenue growth here, especially in Meta's payment vertical. And there's definitely a lot of tremendous potential in further commercializing WhatsApp, not just for cryptocurrency transactions, but overall like e-commerce transactions as a whole. So there's also really strong holiday demand for Oculus headsets, which is their AR/VR headsets. So Oculus is the top downloaded app in the US on Christmas Day, showing signs of increasing consumer adoption and demand for AR/VR. And it's also a positive sign of product diversification, especially with so much talk surrounding the metaverse. One of the negative things that came out of December for Facebook, for Meta, is that there's actually a FTC probe over a new VR deal. So the FTC is actually probing into a proposed $400 million acquisition of Supernatural, which is a VR fitness app. So essentially this probe could just delay the acquisition by up to a year or even longer. So moving into Netflix, there's really not much going on except Netflix started slashing subscription prices in India by up to 60%. It's kind of an ongoing price war with Disney plus Hotstar, which is their main competitor in the space. And of course, they're doing this just to trying to attract more users onto a platform. The significant advantage that Disney plus Hotstar has is that they have an additional product that in live streaming sports, which Netflix has throughout their conference calls has been quite adamant to mentioning that they don't want to get into for several reasons. And this product advantage is quite significant in India, especially because they're able to stream a lot of the favorite, your popular live sports like your Indian Cricket League or your EPL football. So moving into Alphabet, also not much here except that they have mentioned that they are teaming up with Verizon to deliver 5G mobile edge computing. So this collaboration is really just to support real-time enterprise applications like autonomous mobile robots, intelligent logistics, factory automation, etc. And the main goal for this is to enable more companies to gain operational efficiencies by leveraging on 5G technology. So in conclusion, we are still overweight on the FAANGM as secular tailwinds remain intact. Our preference is Amazon, as pressures on its share price lift from eventual easing of freight costs and supply constraints, as well as easier comps versus this year versus last year. We are quite cautious of regulatory headwinds over big tech in general, but we believe that big tech has really been focusing and scrutinizing Meta. Almost every month you've got some new regulator kind of coming down on Meta, and this has been a trend for the last couple of years already. And we definitely feel like, if this continues, there could be some reductions in revenue growth moving forward for Meta, but definitely it still remains to be seen. So that kind of closes off our FAANGM Monthly. I'll now pass my time to Wei Ren to do the technicals on Nasdaq and the FAANGs. Wei Ren.
All right, thank you, Jonathan and Timothy. So I'll go on to the Nasdaq 100 technical outlook. So judging from wave analysis, looking at the subwave, we have completed the first leg of the five subwave terminal. Right now, currently, the Nasdaq is currently going into a range about corrective manner. So you can see that we do have first of all a descending triangle that is potentially going to happen. So we think that there is going to be a gap up, and then after that followed by a correct breakdown. Whether 1530 to 15539 will it be hold is still a question mark, but I guess that if it holds well, then we can confirm that this is a wave terminal Z. Otherwise, prices may travel down to 1462 to 14906 before rebound to the upside. Should it rebound at the safe support zone at 15302 to 15539, then we can prove that okay, this is much more of a what you call it, a bullish flag rather than descending triangle, and then it shall break out the resistance zone, and then price will travel upward to the upside again. So looking at the Ichimoku prices, you can look at the Nasdaq 100 has 2 out of 3 bearish crosses. The only thing that is currently ranging right now, rather than confirming the downtrend, is the candle still remain supported within Sego Span D, which is the part of the Kumo, aka the clouds. So there's a possibility that price may be breakdown, and I have I'll find the support at the support set earlier before, and then prices you do know that that the Kumo is currently ranging. There is kind of like a compression, so it signifies that that currently there's like a ranging momentum going forward for Nasdaq 100. So let's move on to the FAANG plus later Microsoft. So with Meta platform, okay, so we can see that there's a larger correction that kind of like confirm is ABC corrective move. However, I think that prices likely going to range between 310 to 337 region. I believe that this after breaking out of the corrective descending channel, we believe that this leg up from 299 to all the way to 350 region is an impulse move. So hence there was a dark cloud cover, there was a patient line followed by an upside, but prices didn't really close very well with a strong bullish candle. So we believe that there might be a consolidation going forward. You can see that why is because ADX is bottoming out, and then it means that at the current moment is non-trending at the moment. And you can reason is for my next point is DM minus and DM plus has been crossing. So we are likely to see a few days of consolidation. But however, I think that when ADX tends to bottom for the second time, it will signify that market is going for a trending position. But how strong it is, it really depends on the market. Okay. So for Apple is right now I think the most among all the fan stock, I think it's the most bullish manner. So we can see the divergence, double top, and this neckline support at 167.41 is crucial because once it break, you confirm double top, and then you're likely to find support at 153 to 157 region, and then this will confirm the rising wedge. And then there will be a pullback, throwback up, and then before a corrective downside. That's a near-term outlook that we have. You can see that prices still remain on the upside, so nothing is confirmed until 167 is being tested. Just like what my subtitle suggests. So Amazon officially have broken out of downtrend. So prices may move lower to beyond like the higher level of 3,198.89, sorry, and then before rebound, retest the upper slope of the ascending triangle before going down to test support zone at 3035. It should price really play out in this way, then we would look at 3035 to 3080 region. Otherwise, I think can look at 3150 as well. All right, this will be the next important point that we are looking at. Netflix officially in downtrend, but right now, $500 is still believed to be a very strong $500 to 510 region is really a very crucial support zone that we will expect a very strong rebound to the upside back above to $700. All right, you look at the wave theory, we can 1, 2, 3, then we have extended wave 5, ending diagonal and stuff. So this will be a larger kind of like corrective pattern. Okay, so there is another chance that price may go to 525, rebound in a three-way pattern, back to 601 to 616 before going down to $500 before rebound. So in any way, whether it's going to go into a straight fall or a corrective upside before a straight fall down, 500 to 510 is really a worthwhile mentioning level to be watched out. Okay, so Google breakdown downtrend, but I think 225,000 and 2,556 region is currently a support level to look out for. Previously, I issued a report together with Amazon or Marathon. I issued a report here, and then it narrowly closed above 3,000, and then it went back, corrected back to the support, rebound, make a higher low, and then the sell down continue, and the rest is history. Will price actually make an upside? I think it will to 2,895 before a correction down to the downside. So next one will be our last slide. Will be Microsoft. There's a chance that there is much of a better chance for rebound to the upside. And then if it's make out on a strong bullish candle, then $320 is likely to be broken to the upside, and then target 325 before correction, or you can look for the upside to 340. All right, so that's all for now. I'll pass my time to Glenn for the Singapore Banking Monthly. Glenn, to you.
Thanks, Viren. So for the Banking Monthly, next slide, we'll start with the interest rates. So for the interest rates, they were up slightly in December, and the 3-month SOR was up 12 basis points month-on-month to 0.37%, while the 3-month SIBOR remained flat month-on-month at 0.44%. And the 3-month SOR is 6 basis points higher than its 4Q21 average of 0.31% and has improved by 18 basis points year-on-year. For the SIBOR, it is flat against its 4Q21 average of 0.44% and has improved 3 basis points year-on-year. So next slide. So we'll touch a bit on the Hong Kong and Malaysia loans growth. They have shown improvement in November. So Hong Kong's domestic loans growth has increased to 4.23% year-on-year, but fell marginally by 0.02% month-on-month in November. And it has recorded the highest positive loans growth year-on-year in November since July 2021. For Malaysia's loans growth, it saw an increase of 4.3% year-on-year in November and rose 0.85% month-on-month in November. This increase year-on-year in November was the highest recorded since September 2020. Now moving on. Next slide, please. Okay, so for the SDAV, the preliminary SDAV for December, it fell 25% year-on-year to 834 million, as you can see from the left figure, the chart, as the COVID-19 situation stabilized in Singapore. And the VIX averaged 20.9 in December, and this is up slightly from 18.5 in the previous month. So looking at the tables in the middle, the first on the top, the top 5 equity index futures turnover, it saw an increase of 7.9% year-on-year in December to 13.95 million contracts. And this is mainly due to the higher trading volume of FTSE China A50 and the MSCI Singapore Index. And notably, the FTSE China A50 Index, it increased by 8.6% month-on-month to 8.2 million. And this is despite the introduction of the Hong Kong Exchange's MSCI China A50. And you can also see that the Nikkei 225 index futures have increased 41.2% month-on-month to 1.4 million. So at the bottom chart for the fourth quarter 2021, the top 5 equity index futures turnover saw an increase of 16.2% year-on-year to a total of 40.3 million contracts. And this was mainly due to an increase in the trading volumes of the FTSE China A50 and the MSCI Singapore Index futures. So I'll touch a bit on the second half 2021 figures, and this is from July to December 2021. So the SDAV was down about 8.7% year-on-year, whereas the top 5 equity index futures turnover were up 3.5% year-on-year. And our forecast for the revenue growth for this same period from July to December is approximately 3%. The SGX will be releasing its first half December 2022 results on 4th Feb 2022. So moving on. So we maintain overweight and we remain positive on banks. The bank dividend yields are attractive with upside surprise due to excess capital ratios. And the improving economic conditions and rising interest rates remain tailwinds for the banking sector. And the SGX is also another beneficiary of higher interest rates, and that's something to look out for. So that's all I have for the banks, and now moving on to Vivian.
Thanks, Glenn. So now let's take a look at the impact of buybacks on trading volume and also share price, and to answer the question of do buybacks actually matter. So in the next slide, we have examples of 2 large cap stocks. For simplicity's sake, all the charts are labeled in the same manner. So the red line represents the share price in Sing dollars on the in the axis on the left-hand side as labeled. And on the right, we have the axis for the trading volume, which is represented by the dark blue bars, and the light blue bars represent the share buyback volume. So firstly, for Hong Kong Land, they started their share buyback program in September of 2021. All these charts are for 2021. And you can see that it basically send a signal to the market, and that was kind of why the trading volume spiked, and also accordingly the share price also increased, and they continued the buying back the shares in October and November, and the trading volume also remained quite high, even so they were buying back shares even when the share price was already rising. So for OCBC on the right, you can see that actually the buybacks, although it's quite substantial in the form of they bought back maybe say monthly around 3 million shares, but the total trading volume was over 100 million shares. So it was actually less than 3% of the total volume in some months, and in other months it could go up to say 5 or 6%. And you can see that actually the trading volume or the share price wasn't really affected by the buybacks that they did for the year. So in the next slide, let's take a look at the performance of these small or mid-cap stocks. So on the left, we have the Hourglass, which similar to Hong Kong Land, they also started the share buyback when they started the share buyback, you can see that the trading volume spiked and the share price also rose accordingly. And when they continued in July, August, this were at about 50% of the total trading volume. And September, October period was around 20-30%. So similarly, they were buying back shares even when the share price was already rising. And next on the right, we have Broadway Industrial. So they were doing share buybacks in the 2 months of 2021, so in October and November, and you can see that the trading volume and share price both increased, and the share price here at 22 cents was actually the highest in 5 years. So what we can see from these charts, although just 4 stocks of the whole SGX is not representative of the whole market, but we can see that the buybacks seem to have a larger impact on the total trading volume and share price when they actually occupy a larger proportion of the total trading volume, at least for the larger cap stocks like OCBC or Wilmar, at about 20, maybe around 20-30%, then there will be some impact. But for maybe the smaller or mid-cap stocks like Broadway Industrial, even though it was only 3%, there was actually quite some impact to the trading volume and also the share price. Yep, so that's all I have. We'll now be handing over the time to Paul for the Singapore Weekly.
Thanks, Vivian. Next slide. We'll just run through some of the key macro data that came out from Singapore last week. We had the tourist arrival numbers. Although it was better, 92,000 compared to 41,000 the prior month. Obviously, it's still a very poor and very sad number compared to pre-pandemic, which was 1.72 million. So the current number of tourist arrivals in December is only 5% of pre-pandemic. So to reach pre-pandemic, you probably have to, I don't know, jump maybe 50 times, actually more than that. Okay. If we move on to retail, retail was also a bit softer compared to October. But for us, when we look at retail, we focus a bit more on the supermarket sales because it's a more direct link to Sheng Siong. So if you look at supermarket sales in November, it was up 6%. A bit slower than October. I think October was when the lockdowns, when the social restrictions came back on. But when we take October and November together, so that we want to just have a peek into how fourth quarter results will be. You'll see that it's still 8% higher year on year, which is still a strong number, compared to last year when all the panic buying or pantry loading. And supermarket sales remain very robust. It's still like 33% higher than pre-pandemic levels. And I mean, for obvious reasons, everyone is still working from home and the borders are still closed. We move on to US, where there were more important macro headlines. The employment numbers what came out. I think the main takeaway for me at least was that we are already full employment in a way for US. It's already 3.9. The lowest was 3.5. We should get a chart later. The other thing to note off is the wage growth, which we're going to contribute again to wage inflation. So, this you can read it positively and negatively. The positive thing is that it's still going to help the consumer spending because the wages are up. But at the same time, you're going to create this negative spiral where higher wages lead to higher inflation and higher costs. In terms of the other big news was the Fed minutes. Although this is another form of communication by the Fed, because the Fed knows that everyone's going to read and comb this minutes in detail. So I guess it's another way for them to signal that they are going to tighten monetary policy. But the two key statements that came out from the Fed minutes was, number one, they will raise rates sooner or at a faster pace. So not only are they going to raise it fast, as fast as possible, but the rate of raise increase is also going to be faster. The second thing is that they're also going to reduce the Fed balance sheet, which means, Federal Reserve has been buying back bonds, right? So now, right now, according to the minutes, they will be selling bonds. So quantitative tightening. So monetary policy, you're going to get this double whammy where they're going to raise rates and may have to raise it fast, and at the same time they're going to sell the bonds into the market. Later we'll just give you a brief on the SPH REIT analyst briefing. Many may not get access to it, so we'll just give you some highlights. Tactically, the equity backdrop is weak. I mean, it's almost imminent. Like the authority said, we're going to get another wave here, a really huge Omicron wave here, and there is still risk of lockdowns. The other reason is that also we're going to get tighter than expected monetary conditions, and especially right now is made it worse because the Fed is trying to play catch up. So I guess they are so-called transient inflation. So I know on hindsight they might have been a bit slow now, and then they might have to move more aggressively to try and catch up, because we already hit full employment. There's no reason not to tighten, or at least ease the accommodative stance. So right now, I mean, if you're a fund manager now, I think that's why maybe the banks are rallying, because most funds have to be fully invested, and banks is the one place that you can find shelter if you have to be fully invested, because banks will benefit from the increase from the interest rate cycle. The other one that can benefit is also SGX, because do note that SGX has a float from all these derivative open positions, and so the other beneficiary, probably less well known, is the SGX is the other interest rate beneficiary. In terms of the events, the one to note off will be 12th January, where the US will release their CPI number. I mean, hopefully the CPI would kind of meet our expectations. Otherwise, if the inflation number again runs far ahead, then you're going to have another, the market might get hit again, because they might think that the Fed might have to be even more aggressive than expected. This week we will have a Hyphens Pharma webinar, and then followed by the our Singapore strategy on Saturday. Likewise, the following week we have quite a number of listed company webinars. If anyone who's interested, do register. And next slide. Okay, we just have a quick flash on the cases. It's the parabolic. If you look at the blue line, so on the 7-day moving average, we are 1.8 million, and we are rising, we are basically tripling every month on month. The latest number is 2.6, 2.5 million cases per day, because this one is a 7-day moving average. But the worst is that it's still is like tripling month on month, so that's a worrying number. Next slide. If you look at Singapore, of course, the cases now is the imported cases. You can see from the yellow line. I think the latest number is almost hitting 500 per day in terms of imported cases, or around. So just to recap on what the recent Ministry Task Force commentary, the Omicron wave is soon, and it is imminent. And the worst case scenario, we probably in Singapore might get 10,000 to 15,000 cases per day. And the Omicron doubles every 2-3 days. So it'll be a very, very sharp spike, like what we see in UK and so forth. And of course, they are still committed to living with COVID, because it's not possible to eradicate this virus. And the main risk is, of course, the main barometer is the utilization of the hospitals. Yeah, and also there's also a risk that a lot of staff might, like in UK, what happens is a lot of medical staff actually are absent because they got infected by Omicron. Okay, next slide. Okay, this one just to a quick flash on the US employment number. Why we are at full employment, the table on the left. Unemployment rate is 3.9, where the low was 3.5. So you can see that it's one of the lows for the last, 30, 50 I think almost 50 years. No? 3.9 is considered like almost the all-time lows if you look at the last. So this is full employment, and this is going to make the Fed have to tighten faster. This one is just the wage growth. Next slide. Okay, this one is a bit complicated chart. Not sure how to make it easier to look, but this is basically how the bond market, which is in blue, how the S&P in red, and how they perform during QE1, QE2. I look at this chart for some time, but I still can't get any particular pattern. So what we are looking at is especially the red shaded, which is tapering. So when you remember the famous taper by Bernanke in 2013, when that happened, the market took a small dip. It's a bit hard to see, but then it's still, as you can see from the red line, the market still rally. The bond market reacted immediately to a spike, and so this is probably what we're going to get. And when we went to QT, which is quantitative tightening, or if you want to look at the blue line, which is when the Fed tightened, the initial reaction, as you can see from the red line, when the Fed started to raise rates in 2015. Again, this is anecdotal. I mean, just looking at the chart, you can see that the market actually went sideways for some time in 2015, 2016, before it started to rally back up again, and it continued to rally even when you can see from the red line, the Fed continued to raise rates aggressively. And even during quantitative tightening, you can see that the market is up. The bond markets were very weak, obviously, because the 10-year bond yields rose. But again, there are many other factors. I mean, the reason why the market might be up also because Trump was, they had this big, huge corporate tax cut. The economy was strong. So again, this is just for reference. Can't really find any discernible pattern from this chart, but only thing is that the bond rates will rise. So this is going to be a bit negative for bond markets. Yeah, because equity continued to rally, although a bit of lag in 2015, 14-15, when the rates started to climb up. But of course, there are other reasons for it. Okay, next slide. Okay, we just give you a quick flash on SPH REIT because it's quite interesting because they give very good narrative on the retail scene, at least on the Orchard retail scene. So SPH REIT, 66% owned by SPH, and of course the biggest asset is Paragon, 60%, and they have 2 assets in Australia. In terms of the tenant sales, if you look at the chart, it is lower year on year, and that's because of this year, November 21, it was still 2 packs. Last year was 5 packs, so that affected tenant sales. And the commentary for management was that Singaporeans eating come first, so shoppers go to eat first before they go and shop. So when you have a 5 packs, it's very important because that can draw the crowd. Groups of families can come to the mall. So that's the very key attraction for getting the people into the mall. In terms of Christmas, the numbers were of course better. There were queues and so forth, and they could not have they could have what they call it. They can have Christmas trees and so forth just to get the crowd. So that was important. The installations were important. The VTL opening, which is the border VTLs, didn't really matter much because there were still quotas involved. Office crowd also doesn't matter because they're on the shopping belt. Some of the popular items that they mentioned was that luxury watches and jewelry was popular items because consumers seems to a bit view this as there's some resale value, or they call it interested value and longer term value compared to buying fashion items which won't last. So there seems to be this change in discretionary pattern where they like to buy this because there's some intrinsic value to it, or not just some short-term fashion value to it. Again, this is their commentary. And if you notice on the table below, Paragon is still full. It's like 99.7. It's full, the occupancy. And the question was, because of the weak sales, won't the global banks want to leave? But he said no, because the global banks occupancy cost, which is retail, the cost of retail, the cost of rental. For them, the brand presence more important because they want to have a presence in Orchard. So for Paragon, if you are targeting luxury, the most important is to position your mall, position Paragon to be very critical. That means if you, from the global brands perspective, if they want to have a key brand, Paragon, is where the luxury items. So that's strategically, that's the most important thing for Paragon, is the positioning, the luxury positioning on Orchard Mall. In terms of the GST, they said that, I think we all know this, the thing, there's no impact to retailer because it's passed through. But there could be some timing purchase, maybe people buy earlier, then don't buy later. So there could be some volatility in that. And they also just wanted to remind us that the Singapore GST is still relatively low, I guess. And then for Westfield in Australia, it's anchored by two major supermarkets. So that is always very resilient. Yeah, that one is like, it's like NTUC or something over there. So the malls are suburban malls. The comment is that, I mean, this mall is obviously the border reopening mall, but do note that right now there is a offer, a minimum, because of the chain listing, this Cascadian has a minimum offer of 0.964. It depends on how many people subscribe for shares or cash. So if more people subscribe for cash, then for the SPH cash, then that means Cascadian will end up technically owning more than 30% of SPH REIT, and then this takeover offer will occur. Do know that there's been a delay in their quarterly dividends because of this chain listing. Because before they announce the dividend, the auditor and financial advisor has to look at the accounts before they allow them to announce a dividend, which I guess is just to avoid, suddenly they announce some super special dividend and just to pay off the existing shareholders. But again, this is just a short-term delay. Okay, I think that's it for me. I think we can move on to Q&A.
All right, thank you, Bob. So I think I'll start first for the Q&A. So just let me share my screen first. Okay, so based on the question that I have that is being asked, I think the banks have a very strong run today. And yeah, so you can look, let's start with OCBC, which I did a report back then, was here in October. The inverted head and shoulder was here and then tested $12 for quite a number of time, but it failed to sustain. Go into WXY Z wave, 333 corrective zigzag wave. Right now, I think that this will be much more of an impulse wave. But if you can look at that, we still have a strong sell-down gap with $12. So prices did pretty well this morning, and prices just entered and dashed through the resistance at 1209. But if you can look at that, the Fibonacci expansionary gap will be 1.618. It has already passed the wave 3, parallel wave 3. So we are looking at maybe the upper boundary before a slight consolidation before going up to the resistance zone at 12.76. Okay, so this is my view. For DBS, I think you can look at the testing resistance level. This obviously is not going to come to pass. The rising wedge is gone through, so we'll delete it. You can see that the DM Plus and ADX has taken took sharp turn at the 20 level for the ADX, and then price actually gaps up above the resistance level, which is a very good runaway gap. And then prices actually rallied to today at $35 going forward. So if price, looking at the weekly chart, if price is going to go up, sustain its closure, so we are looking at midterm target of $37.41 in the near future. So for UOB, I previously mentioned that this last week, in fact, the multiple resistance has been tested multiple times, and then the ascending triangle has been broken to the upside, came down, touched the support, lower support of the ascending triangle, goes up. Today it just have a gap up above 1.618. Which is a very cool decision. So in looking at the weekly chart, we are looking at the near term at $30.35 moving forward, and maybe the upper boundary at $30.395. All right, so this is my view. Moving on to the Hong Kong stocks, Alibaba did have a double bottom rebound, but looking at Ichimoku is still on the downside. Just a positive note, we have the Tenkan-sen and Kijun-sen crossover. But look at the momentum wise and the ADX, and then the what do you call it, the RSI. RSI is nearing the oversold region, so we are expecting some sort of like a test to 135 to 141 going forward. Previously I mentioned that it's likely to come to 1.618, but however it did not. It formed a down bottom. So, but judging from momentum, I would say that the upside still need to be KIV, keep the KIV, all right? So I'm not very confident of the BABA, but I'm more of confident of JD. So JD had a divergence, gap up, you know, and then there's like a breakout, and then was at a very good support double bottom, and then we shall see that there might be a slow uprising to the upside for JD. Moving to Agricultural Bank of China, they break out above the $2.80 resistance level, but you know it seems that the hourly chart, it seems that there's a selling pressure right now. So it's kind of like a very dangerous moment right now. But we might retest back if it did have a shooting star or graveyard doji. We are looking at $2.70 support level to do a buyback, and then I'll feel I'll get thereafter for that. iFAST break through my potential right shoulder support line. But however, I think that if price managed to, you know, intraday managed to return back on the buy side after lunch, now it's lunch hour for the trading hour. So there is still a possibility of a inverted head and shoulder. Otherwise, I think that, you know, price may just come to $7 before the upside. So you just have to take note for iFAST. For Olam, there is a trend of an inverted head and shoulder. It's still ongoing. Unless $1.80 is being broken on the upside. Otherwise, we'll be looking at $1.60 to $1.65 for the support region. Prices is going to target 1.91 in the midterm. That's we believe. Del Monte 40 cents is still a very tough resistance to break. There is a ascending triangle, so let's hope that it breaks on the upside again for Del Monte. Venture, ever since it break out and then did a double bottom, it has a inverse N wave down. So this like the first, second, and then we have a third N wave likely to come to back to near the support zone 1 at $17.56. That's what we believe going forward. But for Mapletree downtrend is has confirmed, especially after a renewed bearish crossover on 5th of Jan, which is last Monday, and then price likely go down forward to $1.70 before a slight rebound. Okay, so I think that's all for me. So let me check if there's still any technical question that I can answer. I've done. Ping An is still on the very strong downtrend. Okay, so let me see. Ping An is still on the downtrend. Okay, despite it breaks, prices did have a rebound back to the upside, 63 to 65.05, and no price likely to break up, but you know it still remain in a correcting downtrend. This is a symmetrical triangle. Okay, so a clue: if it breaks above the symmetrical triangle, which is at 64.95, then there is a chance that it's a new beginning of a bullish upside. This worth looking for into. Okay, so I will do a last one because of time. I'll do Hang Seng Tech. So Hang Seng Tech, the last one, and then there's a rebound, and then but it's still on the downtrend definitely. So price likely to go back to $1.03 going forward. Okay, looking out, there's a larger falling wedge pattern going here. And then Yangzijiang, nothing much. It's still a consolidative downtrend. I'm looking at 1.08 to 1.14 for downside. Okay, so yeah, that's all for now. I'll pass my time back to my colleague, and then yeah, for new share. Okay, thank you.
Okay, I'll just take some questions while we wait for Glenn and Natalie. Let me take this one first. Hi, Paul, can you comment on iFast acquisition of an 85% stake in BFC Bank? Is it positive to earnings and share price for the company? If one is given the opportunity to subscribe to iFast at 7:30, 7:50 today, is it favorable to take up the subscription? Okay, thanks for the question. So iFast, I didn't attend the briefing. I'm not sure if Glenn did, but from what I understand, iFast bought this digital bank, which is focused more on remittances. There are two main reasons why they did it. Firstly, strategic reasons is that they've been always trying to get a digital bank license and it hasn't been helpful. So maybe with this could, they tried Malaysia, tried Singapore, didn't work. So maybe with this, it could actually elevate their status if they were to try and bid again. I mean, that's one of the reasons. Number two, I think through this bank, they are trying to because most of this, not most brokers, I think most brokers will, or like themselves, would have a lot of float. So customer float. So one way is also with the BFC, apparently they're trying to use this so that they can actually get access to central bank funding, central bank interest rates which can be incrementally higher. Even a 10-20 basis point can be a huge amount. You're talking about billions. And so, but in terms of how it is on earnings, this is a loss-making company. So this won't be positive on the earnings. In terms of the share price, my own view, right now, if you look at the most recent results, their earnings is probably about 30 million, market cap 2 billion. So if you do the nets, iFast is trading at 70 times PE. And this is on very good environment, very good financial environment for brokers and so forth. And the problem we have is that the Hong Kong project will only contribute in earnest 2025. A bit in 2024. So from here to now, I'm not sure there's any momentum in the earnings or anything that can carry the share price. Because at 70 times PE, I think your earnings better be growing very fast the next 2022, 2023. So again, we don't have coverage, just my own view. I think the share price looks a bit challenged at this level, unless they can do another Hong Kong part 2. Otherwise, just based on current the way volumes are trending, like what Glenn mentioned, I don't think you're going to get that kind of big jump in earnings again in 2022. Again, this is just my own view. Okay, Glenn or Natalie?
Yeah, give me a minute. Okay.
In the meantime, can someone put up the slide on the financial ratios of FAANG again? Yeah, there's one question. Can you put the slides up? Yeah, I'll continue, Glenn, sorry.
Okay, sure. So, okay, the first question would be, thanks for the update. Okay, thank you. Why is the SGX a benefactor of the rising interest rate environment, please? Okay, I think Paul mentioned it earlier, but I will just reiterate. So the interest rates actually impact the treasury income on collateral balances held in trust. So this easily is just their float. So their treasury income on collateral balances held in trust amounted to about 72 million for the full year of 2021. And this refers to the float from the derivatives and their balances. And they also did benefit them, and they would earn quite a bit more from it. Okay, the next one.
Glenn, I don't think the float is 72 million. I think it's a couple of billion, right?
No, that is their income, how much they earn.
Oh, yeah. But the float is how many? Yeah,
correct. So this is how much they earn. Yeah.
So how much of it is it of total income? Maybe just to let everyone know why this is so important.
Okay, so it makes up about 22%, just off the top of my head, from what I remember. It's about 22% of their revenue. Yeah, but I just read it was 22%. Okay. Someone just asked SGX. I hope I answered your question. Next question would be, I got one about the outlook. Okay, there's two questions. So the first one is, do you think the slowing property market will weigh on the banks more than the benefit from the higher interest rates? And I think there's in linked with this question would be the outlook for Sheng Siong and banks. So anyway, I'll do the banks one. So for the outlook for the banks, we actually see that interest rates have increased slightly, and we only expect the rate hikes in the second half of this year, 2022. And the market expectations are actually for 3 rate hikes by the Feds. And we have done the sensitivity, and a 25 basis point move can actually raise earnings by 7%. So another thing that we're looking at would be the NIM. And the NIM is to maintain low at it currently is, and this would maintain until the second half. Only in the second half of 2022 would they improve. However, the NIM would be offset, and it has been offset in 2021 as well by the loans growth, as well as their higher fee and commission income. So I think these are the two main points we're looking at for the outlook, as well as the higher interest rates. Local bank stocks up, prices up strongly in couple sessions. What is the possible reason? Are they overpriced now? Let me see. For the thing, why it has went up recently, I think it's been mentioned already by Paul, is that because the Feds have announced that the rates would rise sooner or at a faster pace. So it means that the rates, if hike, would definitely be coming soon. So banks are actually this shelter, and people are now going back towards more sort of a secured investments, and that's why the bank prices have increased quite a bit. And are they overpriced now? As of now, from what we last saw, we still haven't hit our target price yet, I think. Yeah. So I don't think, in my personal opinion, I don't think they're overpriced yet. Okay, I think that's all for the banks. I think I'll hand over to Natalie.
Thanks, Glenn. Okay. Yeah. Hi, thanks, Glenn. Okay, so I have 3 questions that I saw. I'll take the first one about, are REITs negative from the earlier interest rate hikes? So all in, since for the whole of 2021, the SOR increased by about 17 basis points. This is about 89% increase year on year. Of course, this is still lower compared to what the 5 and 10 year averages, which is about so currently December SOR is about 0.36%. 5-year average is 1.24, and 10-year average is 0.77. So it's still significantly lower. We think that probably it will take until 2023 for it to normalize back to this about 10-year average. So there's still a little bit of breathing room for the REITs. Okay, despite this higher interest rate environment, as you know, 2021 was actually a stellar year of acquisitions for the REITs. They made almost about 13 billion in acquisitions. So of course, this will help improvement to accelerate the recovery of their DPUs. Okay. Apart from that, the 10-year bond yield currently is about 1.67%. It has increased by about 83 basis points and about almost 98% year on year. That being said, it is still below the 5 and 10-year averages, although it's trending much closer compared to the SOR. 1.67 for December versus 2.2% and 2.14% for 5 and 10-year averages, respectively. So overall, we think that yes, in this growing or rather rising interest rate environment, this will hurt the REITs. Of course, in terms of cost of borrowing and in terms of attractiveness because of the yield spread, which will be compressed by a higher bond yield. Yeah, so there's still a little bit of time for the REITs to continue acquiring to grow this DPU, but let's not sugarcoat this. A rising interest rate environment is not good for the REITs. A similar question is, I think there's a typo in this question. It says Mapletree Industrial Trust, but actually it should be Mapletree Commercial Trust. And oh, sorry. Oh no, okay. I think there's no typo in this question. Sorry. Let me get back. Okay, sorry. I'll just read the question first. MIT and MLT have weak price action recently. Is this assignable to potential interest rate hike or any potential merger? Okay, so for the REITs, for the REITs, all of them have been slightly impacted since the 31st of December. They're down about 2.5 to 4.5%. And we think this is likely due to the market in general. Yeah, so Mapletree Logistic Trust since 31st December down about 5.4%. Mapletree Industrial down by about 3.3%. So this is in line with the market. I mean, if you initially I misread the question. I thought the question was about MCT and MNEC. So I think MCT and MNEC now is more merger related. Yeah, because they were down by a larger percent compared to 31st December in comparison to the other REITs. Yeah. So I think that's just a general market pullback because possibly the REITs are facing a little bit of interest rate headwinds coming into 2022. Next question is, hi, please comment on CDL. For CDL, overall, this year has been quite a stellar year for the property the residential segment, which is the selling of homes and condominiums. They have managed to surpass their third quarter results have already surpassed what they were doing last year, which already last year, as in 2020, was already a quite relatively good year for CDL. So that just means that they have been able to lock in some of the sales at higher or comparatively higher rates. Now, of course, that will help their margins. And also not to mention their hospitality business, which is a significant portion of their earnings, about 15 to 20% of their EBITDA. That of course the segment is still recovering. Year on year, I think it is up by about about 100%, 117%. But that only brings the RevPAR back to still down by about 42% from normalized level. So it's still below the kind of rates that the segment should be earning. But of course, this should recover as international tourism recovers. There were some positives for CDL. This of course includes they were made an offer for one of their properties in Seoul, the Millennium Hilton Seoul, and they will be able to realize about 530 million in gains from this transaction. So basically, the offer was for 1.26 billion, and the actual valuation of the property was 50% lower than what this was. So the rest of it is just a pure profit. Yeah. So in summary, CDL has benefited from the price increases. We think the inventory risk is relatively low because 26% of their units or their inventory is actually in ECs, and as we know, ECs, they do have their own market. It is for a particular like mid income kind of Singaporeans or Singaporeans PRs, and also that not to mention that another 26%, I think, is of their inventory is actually in mass market kind of units located in the rest of central region, meaning in the more of the suburban areas. So we think that segment will continue to have strong interest. And another the remaining inventory, 35% actually is in the central region. The bulk of it actually comes from 2 redevelopment projects, and because of the low cost of land, there will be very high margins from this project. We are estimating around 30% margins, which are back the kind of margins that you're expecting back in the heydays. But this is because of the low cost of land that they managed to have. Yeah. So overall, CDL we think still positive, and not to mention that right now they're trading at 50% discount to our RNAV. So we think that it is a relatively good entry price. Okay, I think that's all for me for now. Okay, wait, sorry, I just saw another question. Capital DC REIT's financial results remain stable. Why is the price showing strong decline? For Capital DC REIT, yes, I think since 31st December, down by about 5.6%. On the towards the higher end of the market decline. We think that this is largely due to the interest rates more than anything else. That being said, Capital DC REIT, we feel that it's a bit oversold already, because all along their cost of financing has always been very low. It's always been around the 1 to 1.2% kind of range in terms of cost of borrowing. And of course, this is attributed to the low credit spreads that they are afforded due to the stable asset class being data centers. Yeah, so yeah, we're still quite positive on Capital DC REIT. Yeah. Okay. Okay, I think that's all for me for now. I'll pass the time back to my colleagues.
Thanks, Nat. Let me take a couple of questions here. So the first question here, hi, can you comment on C Limited? The share price has dropped 50%. Has the fundamentals of the company changed substantially? Is it a good time to consider buying? So we actually haven't initiated any coverage on C Limited yet. So there's not really too much I can say about it other than fundamentally the company is still loss-making. It hasn't really changed in the since the last few years, except for at the highs in like I guess February or March last year, it was trading at about 30 price to sales. Right now it's currently at 11 price to sales, which some people could consider as a good opportunity to buy. I guess other than that, there's really not much I can say. Sorry.
John, maybe you just share a bit of the two noticeable parts of the business. Yeah. The balance sheet and maybe the profit. Yeah.
Right. So the way that actually C Limited works is that they do issue a lot of convertible notes to raise funds, which instead of just borrowing from banks, which we find is a little bit of a red flag at the moment because it's very heavily dependent on the capital markets. They also, when they recognize revenue, when they adjust their revenue, they include a lot of deferred revenues into their balance sheet, and so there's a lot of moving parts for C Limited. It makes it a bit more confusing. But yeah, I guess we are working on an initiation report for this, so it should be coming out shortly. Moving on to the next question. Hi, fundamentally, any reasons why Nasdaq is so weak? As you can view from the charts we flashed just now. So I guess the Nasdaq is not, you can't really consider it to be that weak. It still gained like 20+% over the last year. It's just that as you can see from last year, I believe the top couple of sectors that really outperformed the market was real estate and energy. So I think they both had 45 or 40+% kind of gains. And I believe consumer discretionary is somewhere up there as well. So it could be last year could have been a play where most investors or institutional investors are moving into possibly more value stocks. I guess supposedly some more defensive stocks because I guess financials was up there as well. So I wouldn't consider it as being weak because when you look at earnings for the third quarter, they still, most of the companies in there still beat expectations, and most of the companies are still growing at a fairly decent rate. So we just have to see moving forward for the next couple of quarters whether the Nasdaq will pick up in relation to the rest of the broader market. I think those are the only couple of questions that I take. I guess I'll pass my time on to my other colleagues. Thank you.
Okay, let me just try some. What's your view on Nikko China EV ETF launch in SGX? Any long-term potential upside? I'm really not sure. I'm a bit, you always worry when so much capital is being put into a EV and how much returns can you get? Because the same thing happened for solar in China, if you can recall. everybody went on to build polysilicon capacity and everybody over invested in polysilicon, and then the returns collapsed and then everyone went to losses. That's something to monitor. I mean, I really no idea. I don't have the data, but you know, China always goes into this over investment stage when any particular sector is especially hot. So we just hope that it doesn't go the way of solar and polysilicon that happened in I think 2011. I mean, for those, yeah, that's my only. But I do notice they have like BYD, so that's fine. But apart from that, I'm not very particularly sure. There's something to watch. Again, this is just my own views. We don't have any. Better to ask our Hong Kong team. Okay, let me just. Will rising interest rates help any other sectors besides banks? Well, I really struggle for that. Because even if you look at cash-rich companies, if you do some mental, this is just a rough calculation. If you look at like if you look at someone like Venture, say Venture makes 300 million or around there. Their cash is 800 million. So over a 1% move, that means they get additional 8 million in interest income. Yeah, it will probably a couple of percentage points improvement in earnings. So maybe the cash-rich companies might get, I don't know, low single-digit kind of improvement in earnings. Apart from that, I don't really see any big beneficiaries apart from the banks and stock exchanges, at least for Singapore. Maybe from cheaper commodities, not so sure. I think not so sure. Sorry, I can't really help on that part. Hi Paul, do you think market already priced in interest rates? Time to accumulate the underperformers? I think my own view is that if you the news only came out last week, so I don't think number one it's been priced in. And number two, it's better to just watch the market reaction. So if you get some very bad inflation numbers and the bond yields don't react, stock market don't come down, then you know it's already priced in. It's better to watch how the price action when news comes out. I think I guess that's the only time you really know whether it's priced in. Otherwise, right now we're probably just guessing, and I don't think it's been priced in because it only came out last week. Yeah. So yeah, so that's my own thoughts. I mean, if we see the CPI read on Wednesday, I think that is very high and the market still doesn't change, then you know it's priced in, and that means the whole world already kind of knows that higher interest rates is really coming up. Yeah, already priced in that. But I guess the biggest worry should be the bond markets. I mean, there's going to be, yeah, there's no way to maneuver out there. Will value stocks in STI benefit from higher interest rates as money flow from growth stocks to value stocks? Possible. I mean, on paper, that should be the way. I mean, on paper, because value stocks tend to be more cash rich, and higher rates also should, number one. Number two, higher rates should taper down growth, so growth stocks could get a bit of knock in terms of the momentum. Again, this is just on paper. I mean, whether it actually happens or not particularly clear. ComfortDelGro analysis, please. I'm not sure if it's technical that you want, but for fundamental reasons, which I'm the analyst covering, we still like ComfortDelGro. There's basically three reasons why we like. I know it performed. It was also our peak last year, and like we mentioned, hopefully nobody noticed that it was the second worst performer in STI, although it was our top pick last year. Okay, but the three reasons. Number one, we like it because their balance sheet actually strengthened in the pandemic. So as they exit the pandemic, their balance sheet went from net cash 70 million to net cash 400 million. Sorry, more than that, I think 500 million. And that's because they generated a lot of cash flow during that period. So it's very rare that anyone who, most of like airlines and so forth, when they entered the pandemic, the whole balance sheet just got destroyed. So we like it. They're actually coming out even stronger, number one. Number two, we like the operating leverage because right now they're suffering a lot from the rebates. So rebates last year was to the taxi drivers. That means, you know, you rent a car, $120 around there. They were giving rebates 20% to 50%. That means this one goes straight to the bottom line. You totally just lose the income. They never give the exact number, but once this reverse, you're going to get this big kick in operating leverage. I think it went from 2050. I think right now it continues to drop. So this quarter it should drop to 15, and hopefully by maybe second half of so far it will go to 0. So you get this improvement and operating leverage because no, this is pure profit, right? When you give a rebate. Then number 3, we also like it because it's 40% down from pre-pandemic levels, which I think is a bit unwarranted, and it's our preferred transport play for recovery for the reopening trade, which kind of delayed for 1 year. Okay, I hope that answers it. Okay. Grab holding. Not so sure on Grab. We don't have any coverage. Straits trading. Yeah, I don't have much right now for Straits trading. I'm not sure, is it technical? No. Viren, you want to do this 3, the last one? I'm not sure it's fundamental technical. I don't know whether you got time or not. Yeah. For Grab, we don't have anything new on Grab. Yeah. If you watch our webinar a few 2-3 weeks ago, I think about a month ago, we were just discussing about the share price overhang for Grab. Apart from that, we don't know much about. We didn't go through the analysis. The part we went through, if you look at week 43, 44 was altimeter. That one was just to show you that the overhang is huge. Yeah. That's why the share price just collapsed, because everyone's cost we thought was maybe $3 or even less than, I don't know, $3 to $5. Yeah, the kind of cost that most of the investors had, the Grab investors. Okay, Straits trading, I don't have anything to update in particular, apart from maybe they might pay a special dividend, I guess, once the results are out because of the because of the ERs, because of selling ARA. Yeah. Sorry, I don't have any particular update. Yeah. We try to give you an update when we have a briefing. Last one is Ascenders REITs. Not sure if you read, not sure if you mentioned anything, Natalie.
Okay, I can just talk briefly about Ascenders. So for Ascenders, we still like the industrial subsector, and we like Ascenders because of their diversified portfolio, and of course their ability and willingness to diversify into other markets and even other other asset types within like a market. Yeah, so that's one of the reasons why we like them. Apart from that, in terms of their portfolio, they are actually predominantly business park. 50% of their portfolio is in business parks, of course, not only in Singapore, but also overseas. For the Singapore business parks, there can be some upside there, given that right now there has been returning demand, especially from the life sciences, biomedical kind of tenants that, of course, could flow through to Ascenders REIT. That being said, also bear in mind that, in terms of the market occupancy for business parks is currently at about 94%, as per 3Q data released by JTC. That means to say that there's still a little bit of excess supply or excess vacancy here that could result in more competition for this space. But nonetheless, this biomedical life sciences, this is a secular growth kind of industry, and hopefully that will help to shore up some of the occupancy for Ascenders REIT. Apart from that, we think that they are still relatively stable. The overseas portfolio occupancy remains relatively high, above 91-92%. Yeah, and of course, for the industrial, even in Singapore, for the Singapore market, there's still demand coming back from some of the e-commerce, as well as for warehousing needs, manufacturing, engineering kind of sectors, because of the management of shifting from just-in-time inventory management to just-in-case inventory management. So of course that will help to that will increase a bit of the stockpiling or warehousing kind of demand. Yeah. They have managed to secure actually relatively good positive reversions for the year. In 3Q, it was 3.7% for the whole portfolio, 8.9% for the second quarter. Positive reversions. That is, of course, a positive for Ascenders REIT. But I think a general word of caution from the managers is that competition is a little bit stiff, and they might they are just basically tapering their expectations. Yeah. Okay, that's all for me. I'll hand the time back to Paul.
Yeah, okay. I think with that, I'd like to thank everyone for your time and for all your questions. So we hope to see you again next week. And do join us for our Saturday our Saturday strategy session 10 a.m. if you do have the time. So thanks again, everyone, for sharing your time with us and all for your questions. Yeah, thank you again. Take care. Bye-bye.